Thank you very much, Kyle. So our presenter today is Paul Jannke. Paul is a principal at Forest Economic Advisors, LLC, the premier source for North American wood products analysis and information. His main area of expertise is North American lumber markets. He has spent the past 25 years analyzing lumber markets and providing reliable, insightful forecasts, and is known as one of the industry's top economic analysts. He's the author of FEA's Lumber Advisor and Lumber Quarterly Forecasting Service publications. He has presented at many international conferences on the markets for lumber, engineered wood products, and structural panels, and he is recognized as a leading expert in these areas. If I could have the previous slide, Kyle, I'll go over continuing ed credits. So for continuing education credits, I know that some of you are interested in those. I've reached out to the various boards of licensure. Maine and Massachusetts gave me a certificate and told me that this is eligible for 1 hour or 1 credit. The other organizations that issue CEU credits have told me that you need a certificate of attendance, which I can give to you if you email me at the email below after today's webinar, and I will follow up with you. For Maine and Mass, I can also send you the certificate that they provided to me. If I could have the next slide, please, Kyle. And just a quick disclaimer that the information here is not intended to be tax or legal advice and should not be relied on by recipients for such purposes. Just the standard disclaimer that we always issue on our webinars. And with that, I think I will turn it over to Paul to begin his presentation.
Great, thanks, Chris. Can you guys see my screen?
Yep, we see your screen just fine, thank you.
So thank you guys for coming to listen to me today. My presentation is just going to be on where we see the lumber markets going in over the course of the next year to 2 years. Most of my talk will be 2021. I've been doing this for more than 25 years now, and these past 2 years, so 2020 now into this year, is probably some of the most difficult forecasting times because things are changing so quickly. So we're certainly getting a good sense of where 2021 should be. So we're quite confident in our 2021 forecast. And then, once we get into 22, 23, there's definitely some risk on the upside, at least in the near term. I'll talk a little bit about that. And yeah, so anyhow, with that, I think one of the big things, I normally have an outline where I sort of lay out what it is I'm going to talk about, but I think that this presentation can really be summed up with some pretty simple words, which is that it's really difficult to find anything difficult to say about the economy, end-use markets, lumber markets, panel markets for that matter, really any of the markets, the wood products markets in 2021. So the only real tough thing that you could say potentially is that if you're looking to buy a new home or if you're looking to renovate your existing home, then yeah, it's not the best market for that. We're hearing stories across the country of bids coming in, 10 to 20% over asking prices on homes and still not getting the job done. So, home prices are skyrocketing, and certainly if anybody's tried to do any renovation work, they know exactly what's been going on in the lumber markets, because it's not only is it difficult to get a builder, but the products are extremely expensive as well. So, but if we're looking at this from the perspective of a landowner or a producer or even a home builder, then these are really, really good markets. And I know the home builders are a little bit put out by the high product prices right now. They're somewhat focusing on lumber, but panel prices have gone up even more, and all the other products that they're putting into their homes are going up as well in prices. So, it's not just the lumber markets. So with that, I'll get into it. I have a lot of slides, probably a lot more slides than I need, so I'll go through some of them fairly quickly, especially when I get into the economy portion of it. But I did want to keep those slides in there because if you would like a copy of the presentation, then just send me an email. My contact information is at the end of the presentation, and I'll show that slide, or you can get the presentation through Chris as well. So in any case, I wanted to put into a little bit of context where we're at right now with lumber prices relative to history. This shows lumber prices going back to 1990. We actually have the data going back to 1970, and you would see that after adjusting for inflation, we are at or very close to record high lumber prices. And the only other time we were this high was back in the early 1970s. So extremely high lumber prices right now. Why is that? Well, it was a combination of factors that occurred in 2020, which caused prices to skyrocket as high as they did. Starting actually in the second half of 2018, when we started to see demand, so R&R, repair and remodeling activity, started to weaken. Housing starts started to weaken a little bit as interest rates had moved up, and especially into the first half of 2019. So prices had come off, lumber prices had come off, and we started to see mills losing money. And so we started to see quite a few closures in 2019. Then we get into 2020, things started to look a little better. It looked like the markets were going to recover and bounce back. COVID hits. And looking around the world, where if you look at China, COVID hit first, then it moved into Europe and Italy in particular, and then into North America. And so, but China and Italy were at late 2019, early 2020. So as a country, we had a sense of where our economy was going to go by March, April. Really by February, March, even before we started to see the massive lockdowns and the stay-at-home orders. So you could look at China and see the huge drops in industrial production. You could look at the stay-at-home orders in Italy and see the complete halt to their economic activity. And the industry saw this in other places. They saw the lockdowns coming, so they cut back production dramatically. And with that cutback in production, we also didn't just see that at the mill level. We also saw it at the buyer and the dealer level, where they stopped buying and tried to get rid of their inventories. Then, as we moved through 2020, demand actually ended up being quite a bit stronger than anyone thought it was going to be. Interest rates were extremely low. The government was giving cash to straight out across the economy to try to bolster the economy. So people had money, and interest rates were low. They were stuck in their homes, so they were just kind of looking around, looking at all the things that needed to be fixed. They were working from home, so they might want to add on a little bit. So the R&R markets were very, very strong. And at the same time, people wanted to move out of the cities where you really couldn't do anything. So we saw the new home construction market strong as well. So demand actually increased in 2020 when both dealers who were buying wood and producers who were producing wood thought that it was going to decline. So we had an imbalance between demand and supply, which caused prices to skyrocket. Initially, producers and dealers didn't think that those higher prices were sustainable, so they didn't produce more, they didn't buy more. And by the time they realized that those higher prices were sustainable, they were having difficulties because of lockdowns and quarantines and actually getting production to be at or above rated capacity levels, which you would typically see once prices get up to the levels that we had seen last year. So because of that, we saw prices jump very, very high. Then in October, November, prices started to come off. There was a sharp drop, but that did not last, because as soon as prices got down to if we're looking at the Eastern SPF prices delivered into Boston, as soon as they got down below 700, dealers jumped back into the market because they saw that as a good, with very low inventories, they saw that as a good time to buy. And so now that brings us to where we're at today, which is again, close to record high lumber prices. So where do we think they're going to go from here? Well, this forecast we're actually going to do a new forecast tomorrow once housing starts come out. So our forecasts, we always start them when housing starts get released. So this one is from February. And you can see that we had prices peaking in March. And then starting to come off in April and plunging in May, June down to around $800. And that we expect that to occur as dealers take a step back. So they have been buying wood. That's part of what's driven up these prices. Prices are extremely high, so dealers are nervous about buying any more wood at these high price levels. And then we do expect to see some of the transportation disruptions ease as we get into the latter half of March and April. It starts to warm up in Canada, wood starts flowing again. So we do see a little bit of a crack in these high lumber prices. But as soon as prices again get down into that $700-800 range, we think that dealers are going to step back in and buy because inventories are quite low, and that should cause a rebound with prices bouncing back up into the 900s. And then in the second half of this year and into next year, we do see prices coming off rather dramatically. So what's behind this whole outlook? Well, one of the things that I mentioned was inventories are low. The fact that producers stopped producing, or didn't stop, but cut back dramatically on their production in March, April, May of 2020, and that really got the ball rolling. And then the inability to ramp up production because of COVID related quarantines and stay-at-home orders. So that limited their production, limited their ability to ship wood to dealers. And so what this graph shows is it shows the dealer stocks as a percentage of consumption. So it's the month's supply of wood that's available. The blue area, the top of the blue area is the 20-year high, actually 21-year high. So that goes back from 2000 through 2020. That's the 21-year high in the month supply of wood at the dealer level. And then the bottom of that blue area shows the 20-year low. And you can see that for most of 2020, that was the low, the historical low that we had ever seen. And I threw in the previous low just so you know that just how low inventories were in 2020. They were significantly lower than historical lows. So historical lows were around 1.2 months supply, which is a little over 5 weeks. We had seen them drop down to 0.8 months supply. So very low inventories last year. And as we start off this year, we're again at record lows for this time of year. So that's part of the reason why we expect to see prices stay high in the near term. Another part is that demand is going to remain strong, and I'll get into that in a lot more detail when I cover the end-use markets. But we do expect demand to be strong over the next year, but in particular strong over the next 6 months. Having said that, we do see prices coming off, as I mentioned. Why is that? Well, for one thing, with the high prices that we have, the dealers, dealers are going to be hesitant to buy. And on the production side, mills are making a very strong return right now. So the red area here, or the red bars here, show cost. The duty is shown in yellow, and then that dashed line is the current price levels. And then the blue dot shows the ratio of the average sales price to the cash cost. So I take into account average product mix at the mills there. And you can see that even for the least profitable region of British Columbia, they're still earning 3 times their cash costs on their average sales price. So mills are making a significant amount of money right now. And how do you respond when you're making a significant amount of money? Well, you ratchet up production. So we've seen that happen already. And what I try to do with this slide is this really captures a lot of what I've talked about already, which was when I mentioned that in late 2018 and 2019, we saw lower prices, a lack of profitability. And so we saw across the board mills reducing production. So the right-hand scale is the actual board feet of total North American production year-over-year change. And then the lines, which are the left-hand scale, is the percentage change by region, by producing region. And you can see that throughout 2019, we saw production come off year-over-year across numerous regions. And in particular, in total, we saw pretty big declines in production. Very sharp decline in Q2 of 2020 with the COVID shutdowns. But then in the second half of the year, with prices rising, we did see production start to increase again. So our situation coming into 2021 really is quite different than the situation coming into 2020. In other words, coming into 2020, we had just had 2 quarters of declining year-over-year production, whereas coming into 21, we have a half a year, 2 quarters of quite strong rising year-over-year production. And then the other piece for 2021 is we are not going to see that big year-over-year decline in production that we saw in Q2 of 2020. Obviously, no COVID shutdowns, and with the high prices, we're going to see mills actually operating at their to their greatest extent possible. On top of that, we do have new capacity coming online. So this is both a plus and a minus, actually. So the plus is obviously that expansions, restarted idled operations, and then Greenfield Mills. So, well, Greenfield Mill, I should say. So that's the Westervelt Mill that just started. Most of these restarts and expansions and new mills there, the new mills in particular, are all in the south. Some restarts in Quebec. So on the positive side, you do have that Westervelt Mill startup of the Westervelt Mill. You are going to see the Binderholz mills, the old Klausner mills in Live Oak in North Carolina. Those are going to restart this year. So there's definitely new mills coming online. But because of the low prices in 19, and then when COVID hit, the COVID recession, an absolute shutdown in capital expenditures, that's going to prevent any new mills aside from the Westervelt Mill from starting up in 2021. So it's really not until 2022 that we're going to see a more rapid expansion in southern capacity. So one of the other components and why we think prices are going to remain strong in the near term, and I should point out that while we do have prices coming off fairly sharply in the forecast, even in 2022, prices remain well above historical averages. So we're looking for prices to be $100 above historical averages, $100 to $150 above historical averages in 22, even though they're down sharply from the very high 21 levels. So why that strength in 21? Well, part of it's the low inventories, but part of it is simply a very robust economy and strong end use markets. So you can see here's our forecast for actual consumption in the US. We're looking for about 7% growth in 2021, and then about a 1 to 1.5% decline in 2022. And I'll get into that decline a little bit later. But in total, this is about a little under 4 billion board feet of new demand in 2021. So why are we so optimistic? Well, every single economic indicator that we look at is positive. So it's tough to forecast what's going on in the economy right now without taking a quick look at what's happening with COVID. And you can see that the winter surge in COVID-19 cases is over, and we are now back down to levels that we haven't seen since July. So the trend is definitely on the way down. And this is before we've really seen extensive vaccinations. And we are moving from a period of vaccine scarcity to a period of oversupply of vaccines. So the US should have about 500 million doses of vaccines by May. And we're going to be in a period where you're actually going to have the states calling people up and asking them to get vaccines, as opposed to where we're at right now, which is people struggling to try to find an appointment. So we're quickly moving from that difficulty finding vaccines and appointments to having a surplus of vaccines and appointments. And so as that happens, we're going to get to herd immunity much more quickly. And so we don't see any real risk of a COVID-related slowdown. Some other factors. Well, income is extremely strong. So the green line shows actual disposable income in people's pockets. And this is just an index based from January of 2019. And you can see the big spikes up in March of 20 and again in December, January of this year, which are related to government transfer payments. So the yellow line shows you the incomes without government transfer payments, and the green line shows it with the government transfer payments. So that money, whether it comes from the government or whether it comes from actually working, is still going into consumers' pockets. And what are they doing with it? Well, initially they saved it, and that's the red line. And you can see that difference between the incomes and the spending is their savings. And then as we move now into the early part of 2021, people are starting to spend it. So we're still seeing a lot of savings going on, but consumer spending is almost back up to where it was prior to COVID-19 hitting. Retail sales doing so this is where I'll start to go through these pretty quickly. Retail sales are well above where they were pre-pandemic. So it's interesting, you're in a recession and retail sales are now very, very high. So this is indicative of the fact that we're almost certainly out of the recession at this point. We won't know that for a while. If we're not out now, we'll be out shortly. What are people spending money on? Well, a lot of it's getting spent at beer, wine, and liquor stores. So, and this is probably going to spike up tomorrow for Irish Christmas as well. So we'll see a little bump up with that coming shortly. But it's not just the consumers who are spending a lot. If we look at new orders for non-defense capital goods, those have skyrocketed as well. So real sharp V-shaped recovery there. If we're looking at a little more specifically towards our end use market, which is mortgage rates, mortgage rates have popped up a bit in recent weeks, but they're still almost 200 basis points, almost 2 full percentage points below where they were in late 2018. So yes, mortgage rates are up some, but they're not up much. And if we're looking at this on a sort of go forward basis, there's really not a lot of signs for much in the way of inflation, which means it's unlikely that mortgage rates are going to go up much. What do I mean when I say there's not a lot of signs of inflation? This is just simply the expected inflation based on the difference between nominal and the Treasury inflation protected security bond yields. So that's what the market thinks inflation is going to be. And you can see that the March reading of 1.48% is extremely low. So the bond market participants think inflation is going to be about 1.5%, which is, with 1.5% inflation and the Fed saying that they're not going to be raising interest rates, it's unlikely that we're going to see much of an increase in mortgage rates over the next 6 months. I do have to say that that's our big concern for 2022. So towards the end of this year, we do expect to see interest rates moving up a bit, and that combined with the really massive increase in home prices that we've seen in 2020 and expect for 2021, that's going to start to affect affordability. So we do see a bit of a downturn, a bit of a pause, if you will, in housing starts. So it's not like we're looking for housing starts to come off in 2022 from 21 levels, but they'll be flat for the year. And then if we're looking at the R&R markets, so those markets, which I'll talk more about later, we do see those coming off as well. Very strong R&R markets in 2020, again in 2021, they're remaining strong. So a bit of exhaustion, if you will, on the repair and remodeling, the additions, the alterations, the renovations, the improvement markets. So we'll see a bit of a pullback from those markets as well in 2022, which should cause a slight downturn, about a 1.5% downturn in actual consumption. But still, thinking back to the more near term, other positive indicators, builder confidence is extremely high. So we're not at the record levels we were at back in November, but still we're very near all-time highs. And in fact, we're above, aside from November, December, we're above all-time highs. And it's only 1 month, I know, but last month we had a little bit of a bounce back in the builder confidence. And every builder that we talked to, and I was just on a call with 15 builders yesterday, and they all said that they were building as many homes as they possibly could. Their only limiting factor was the supply, the product supply. And they didn't just say lumber, they said all products. So that's the limiting factor there. So why are builders so confident? Why are home prices rising so quickly? Why do we expect housing starts to be so strong? Well, if you have a particular level of demand for housing starts, you can meet that demand through either inventories or through building new homes. And if we look at inventories, they are at rock bottom. They're at record levels, record lows relative to all of the historical data that we have that's available. So you can see that at 1 million units, the inventory of existing homes is very low. So if there's strong demand for housing, you need to build a new home. And there is strong demand for housing. So this is new home sales, and that's really the best indicator of demand for new homes. If the new home sales are up, if people are buying homes, that's just indication that there's strong demand. And here's the crazy part about this. So if you look at last month with 923,000 new homes sold, that translates into a little under 1.85 million units of starts needed to keep inventories flat. If you look at the last 6 months, we averaged 926. So that's a little over 1.85 million units needed to keep inventories flat. So we're not building at 1.85 million units, and builders can't, it's unlikely that builders could, given supply side constraints, build at 1.85. So inventories are likely to continue to come down. So the demand side for housing is 1.85, and the supply side is limiting us to 1.5 to 1.6 million this year. So we've said that a lot of times, and we've been saying this for a while now, that the demand for housing is likely 1.8 to 1.9 million units. And the only reason why we're not building more is because of builder supply constraints. And that's almost certainly borne out by this data. So these strong home sales are indicative of the fact that builders are going to be, or indicate that builders are going to build as many homes as they possibly can over the next several months, and likely throughout 2021. More data that indicates that. Well, what this graph shows is it shows you the month supply of homes for sale, lagged 6 months on the x-axis, and then on the horizontal axis, and then on the vertical axis, it shows you single-family home starts. So you can think of this as single-family home starts 6 months after that month's supply of homes for sale. So what do we see? Well, we see obviously a downward sloping line, and that's because the fewer the month's supply of homes you have, the higher the starts are going to be 6 months from now. I highlighted that little red box because that shows the time, or that shows the periods in which we had fewer than 4 months supply of homes for sale. And for almost 6 months now, we've had fewer than 4 months supply of homes for sale. Historically, that's meant single family starts of 1.2 to 1.8 million units, just single family starts, not total starts. So if you're thinking that we typically build about 300, well, right now we're building about 350,000 multifamily homes. At the low end, 1.2 million single family starts with that 350,000 multifamily. That low end of where we should be over the next 6 months is about 1.5 million starts. This is a great slide. This is a new one. We haven't shown this one before. And this is just another indicator that housing starts should be very strong in the near term. And so what this shows is the red line. Oh, sorry. So this is Z-score. So just first off, Z-score is the deviation from mean measured in standard deviations. So if you have a Z-score of 1, you're one standard deviation away from your average. If you have a 1 standard deviation above your average, if you are -1, you're 1 standard deviation below your average. What is your average or your mean? Well, for these things, it's the mean or your average number of completed homes in blue. It's your average number of homes under construction in green, and it's your average numbers of homes not started but for sale in red. So I think a lot of this makes sense. The blue is completed homes, so we know how many homes are completed, and you can see that there are a full standard deviation below normal level of homes that have been completed. So there's a lot fewer completed homes available for sale right now. We can see that we're roughly at a normal level of homes under construction. That's the green line. And then the homes that have put up for sale but not yet started, that red line, we're almost 2 standard deviations above the mean there. So what does that mean? Well, that's indicative of the fact that over the next 6 months, we should have very strong housing starts because those are prepped lots getting ready for homes to be started. And you can see that we're quite a bit higher than we normally are in terms of the number of prep lots ready to go. So any of these short-term indicators, they're all pointing for very strong housing starts in 2021. If we want to look at it a bit longer run too, things are going to be very strong. So you can see that we're back up to pre-pandemic levels at this point in terms of our housing starts. But probably more interesting on this line is on this graph is the area between the green line and the red line. So the red line is actual housing starts, and the green line is underlying demand. So a bunch of factors that go into that, but essentially it's our age. It's our population broken out by age class and the propensity of each of those age classes to form separate households, which is the main driver for that underlying demand. And why is that important? Well, if we know that we have roughly 2 adults per household, and we know that we add 1 million new adults to our population, then that means that we need 500,000 housing units to house those 1 million adults. If we add 3 million new adults, which we've been doing, then a little under that, and we have roughly 2 adults per household, then we need 1.5 million housing units. So it's rough, and there's a bunch of other things that go into that, but roughly that's what you can look at with that green line. So you can see that so we've been adding those adults. So we know how many adults we've been adding, and yet we've been building far fewer homes than what that underlying demand indicates that we would need. And because of that, we've ended up in a situation where we have dramatically underbuilt our the demand, that underlying demand. And how is that possible? What does that mean? Well, that's adult children still living at home. Kids, I was just talking with my buddy this morning actually, and his daughter is back from college, living at home and working and looking for a place to live. That's adults, it's grown-up adults living with their children, with their adult children. So parents living with their children. That's adults living together who wouldn't otherwise choose to live together and have not been able to separate initially because of affordability concerns with the recession coming out of 2000, the Great Recession in 2008-9, and then as time went on, the inability of the housing industry to build enough homes to meet demand, which we are now seeing come through in significantly higher prices. So there's a tremendous amount of underlying pent-up demand, if you will. So we've underbuilt for a number of years, which means there's a lot of people who want to separate out who can't separate out. So that's one very positive thing for the housing market and why it's going to stay strong. In addition, there's some very, very strong demographics underpinning a strong housing market for an extended period. So what is that? Well, if I had asked you what the biggest age groups were in the US, a lot of people would say the baby boomers, but it's actually not. It's the 29 and 30 year olds right now, or 30 and 31 year olds right now are the two single largest age years. Why is that important? Well, 29, 30, 31 year olds, so when you're in your late 20s and early 30s, those are your prime first time home buying years. So these folks, that big bulge of population, they're moving into their prime home buying years. And that's really what makes this coming out of this recession so different than coming out of the 2008 recession. So in coming out of the 2008 recession, that's that green line, we see there was a very strong demographic headwind. And that is that there was actually a a dearth of folks in their early 30s, which is that prime home buying years. Whereas coming out of the COVID recession, we have a huge spike of folks moving into their early 30s, which is again their prime home buying years. So because of this, we actually see very strong housing markets for the next 5 years. And we would actually be forecasting 1.8 to 2 million units of starts per year if it weren't for the supply side constraints. So supply side constraints are preventing us from building more homes. I can get into that more in questions if you guys want. Some other positive news is single family share is on the rise, both in the US and Canada. And it's going to continue to increase. There was a shift that was occurring prior to COVID. COVID has sped that shift up. There's not as much incentive to live in the cities anymore because you can't do a lot of the things that you used to be able to do. And I know that once COVID's gone, that won't actually be the case anymore. But still, that shift will continue because it had started to occur prior to COVID. And what was the cause of that shift? Well, that's that big bulge of population in their early 30s. That's when folks tend to have their first children. When you have children, you want to move into areas of low density housing because of the way we fund our education system. So why is that? Well, when you have children, you want to move to an area with a good education, to a town that has good education. If you want good education, you want to have high tax dollars per student. You get high tax dollars per student in low density housing. So that's single family housing. So the new home construction market is going to remain strong because of underlying demographics. And in particular, the single family market will also remain disproportionately strong relative to the multifamily markets for the next 5 years because of our age class distribution. But it's not just the new residential construction markets, which are strong. We also see a lot of strength in the R&R markets. In fact, I was just at Home Depot this weekend. My wife snapped a picture of me leaving. And I was there with about 1,000 of my close friends. And so we can look at just same store sales for both Home Depot and Lowe's for the November, December, January quarter and see that they're up by 25% plus. So very, very strong markets. So, that's anecdotal evidence, but we can also look at the actual data behind it. And you can see retail sales at building materials and supply dealers have absolutely surged. So that 14.2% increase, that was what occurred over the summertime when people were originally locked down with COVID. They had nothing to spend their time or their money on but their homes. And so we saw a big surge then, and we've just seen it trend up since then. So people are still doing projects on their homes, and they're likely to continue to do that this year. In fact, a lot of people weren't able to get their projects even started in 2020 because of the high demand. So we're seeing a lot of spillover into 21. Now by 22, we should see some fatigue, but for now, should be pretty strong. Medium term, R&R markets are going to remain strong. Why is that? Our housing stock is quite old. We're in 2019, which is the latest data available. Our housing stock was 42 years old. So we're at 43 years now, likely 43 and a half years old now in terms of our average stock. So if we look at a home that was built 43 years ago, that home was about 800 square feet smaller than a home that's built today. If we look at the average house, so not every one of those homes is still the same size because there's been a lot of R&R activity that's occurred, but still, if we look at the average size of the current stock in the U.S. today relative to the a new home, you're still looking at to an average new home. So that's both multi and single family. You're still looking at the average stock being about 20 to 25% smaller than a new home. So what does that mean? Well, if you buy an average home, you're likely going to want to fix it up. How are you going to do that? Well, you're likely to tap into your home equity, which is now at record levels. So we have piles of home equity out there. We have old homes, which on average are 25% smaller than a new home. And so what are you going to do? Well, you're going to tap into that equity, which people have started to do, and you're going to improve that home. You're going to add an addition. You're going to you're going to make some alterations and make it a little bit bigger. So the good news is that home equity exists, and our people are starting to tap into it, especially with the low interest rates. And then the extremely good news is that we're nowhere near the peaks in cash out refinancing that we saw in 2005-06 that led to the Great Recession. So people are tapping into their home equity, but they're doing it at much more reasonable levels than they did prior to the Great Recession. So going forward, we see a bit of a slowdown in R&R activity. And that's going to come in this latter part of this year, beginning part of next year, as we do see interest rates rising a little bit, and we do see some fatigue after very strong 2021 in terms of R&R expenditures. But then longer run, as we get out into the middle of this decade, that aging housing stock and the high level of home equity and continued low interest rates should all lead to decent R&R activity. So all of this put together, I had mentioned earlier, we're looking for pretty strong growth in consumption, about 3 to 4 billion board feet, 7% growth in 21. So what does that mean for production? Well, if we look, the bars show you production going back to 2014. And then what I did at the last two bars is I showed production in the second half of 2020, because, looking at all of 2020, that incorporates the big slowdown that we had in Q2. So instead of doing that, I did that. You can see that 20 bar, but I also put in just production in the second half of the year, because that's a run rate, if you will. That's an annualized rate that we were seeing of production in the second half of last year. But still, even with that, we're still going to need 3 billion board feet plus of increased production in 2021 to meet consumption levels. So that's that yellow portion of the bar on 2021. So production, North American production is going to have a hard time increasing by 3 billion board feet above where they were in the second half of 2020. So this is going to be a tall, this is really going to be a tall order for producers. More reason why we expect lumber prices to remain high. Part of the demand is going to have to come from reduced exports. So we don't see exports increasing at any point in the next couple of years. And part of that demand is going to have to be filled by increased imports. So we did see imports jump in 2020. They were up 30%. And we see pretty sharp increases, another 25% in 21 and about 13% in 22. So the bulk of that is going to come from Europe, where they're dealing with the spruce bark beetle epidemic. And I just wanted to put this into a little bit of perspective. The red line shows the volume of beetle kill of the mountain pine beetle in British Columbia, and the green line shows the annual volume of spruce bark beetle kill in Central Europe. And just so you know, I don't have it in here, but the 2020 data preliminary that we have so far is going to be above the 140 million cubic meters that we saw as a peak for BC interior back in 2005. So the scale of the devastation is similar in Europe as to what we saw in British Columbia. So there's a lot of fiber there that's available. Just real quick, I don't want to get into this in too much detail because we don't have that much time, but real quick, the shelf life of the killed spruce is not as long as the shelf life of the lodgepole pine from British Columbia. So whereas in British Columbia, we saw that fiber being available until 15 to 17, sometime in that time frame, before we really started to see the British Columbia mills shifting back to much more green, more expensive green timber, and before we really saw big declines in their production. And in Europe, it's going to occur a lot faster. So simply because they don't have an 8-year shelf life. So the shelf life is, according to the Europeans, it's less than a year, but I'd say that depends on the economic conditions affect that, as do microclimates. So we're assuming that the shelf life is more on the lines of 1 to 2 years in our modeling. So putting it all together, strong demand, not a lot of growth in capacity in 21. And so that is going to lead to significantly higher operating rates, back up to around 90%, which should lead to higher prices. The high prices that we see so far this year and that we saw last year are leading to significant investment in capacity. There's a number of mills announced capacity expansions, restarts, greenfield mills coming online in 2022. So that should increase capacity faster than demand. And we do have demand coming off a little bit, as sort of pause, if you will, in the on the demand side. And so operating rates should fall again in 2022. So with that, I tried to keep it to 45 minutes, so leave a little bit of time for questions. I'm happy to open this up to questions if you guys have any.
Sure. Thank you very much, Paul. So we do have a few questions. One is, you talked about the underbuilding of housing stock. And when you're factoring that in, are you looking really only at single family housing, or are you looking at multi-unit building as well, specifically 2 to 4 units?
Yeah, so our demographic analysis is all units. So we didn't actually go so far as to look at mobile homes as well, but I didn't actually include our mobile home analysis in there because, you know, it's 100 to 150,000. But we don't. So if we're looking at the 1.5 million, that is that's whether it's multifamily or single family. And then the way we break that out is based again on demographics and what each age group has a different propensity to demand single versus multifamily. So in your early 20s, there's a higher demand for multifamily. In your sort of 80 plus, there's a higher demand for multifamily. In your early 30s, there's a much higher demand for single family. And then as you move, that kind of stays steady up into your, into your 50s and 60s, and then you do start to trend back towards multifamily at that point.
Okay. Another question is, we've seen a real surge in softwood lumber prices, but hardwood lumber prices have lagged and have not performed as well in recent years. What do you see going on for hardwood outlook?
So we don't do a hardwood forecast. So it's really tough for me to comment on that. But I will say some of the things on the hardwood side is that, a lot of the demand for hardwood comes from furniture, flooring. A lot of that is exported to China, made into furniture or flooring, and then shipped back into North America. So from those markets perspective, if we're talking about some of the higher grades, the export market to China has been weak with the trade restrictions that we saw. We do think that those will start to ease, and that we could see a little bit stronger demand on the hardwood side over the next couple of years.
Okay. One of the things you mentioned, going back to housing, was that new homes being built are significantly larger than existing stock on average, and that we see a lot of older homes being much smaller square feet. Yet over that same period, average family size seems to have decreased. What do you think is driving the reason for the increased square footage per house?
Everybody wants to have a home that's as big as their neighbors. So I think there's just so actually I should specify here. So home sizes peaked probably in 2018, 19, and then they've actually been coming off. So second half of 19 and 20, they started to come off. So one of the things that was driving the increased home size through 18 was the fact, if you look at who was buying homes, they tended to be wealthier folks, they tended to be older folks. and builders weren't building homes for the first-time buyers. So instead, they were, because if you have a limited supply of lots, if you have tight more, so it wasn't that interest rates were high, but lending was really tight. So if you had tight lending, it was really only the high-end folks who could afford the home. So the homes that were getting built were disproportionately large. And to put some perspective on this, at the height of the recession, the owner-built share, which if you're building a home as an owner, you're typically building a much larger home than if you're just building a spec home. The owner-built share got up above 35%, whereas historically it's around 25%. So that just shifted, that pushed that, because you had such a high owner-built share, that pushed the sizes higher. But actually starting in 2019, with this surge in demand from these first-time home buyers in the 30-year age bracket, in that range, we actually started to see home sizes decrease. But still, even with that decrease from that peak of 2,600 down to a little under 2,500 today, we're still at 25% larger than the average size. Because don't forget, we're comparing home size, we're comparing the home sizes built today to the average stock. In the average stock, the median home was built 42 years ago. So you're building it's a little tough to look at. The time frames are so long between when your average home was built and today, 42 years, that there's been a lot of changes in people's preferences.
Okay. For the landowners and lumber loggers in the audience, as you know, Paul, most of the harvested wood goes not to lumber but to pulpwood and biomass in terms of the total amount cut. Do you have any outlook as to those markets? Yeah,
so again, those are not my prime area of expertise, but we do think that with the strong overall economy, we think that those markets should remain strong. So we're looking for a continued strength across those markets as well, not to the same level that we've seen for the new housing markets, but still, if you think back, I didn't throw the slide up there, but we're likely to see GDP is likely to reach pre-pandemic levels by the end of this year. So initially the forecasts were 2023, 24 before we got back to pre-pandemic GDP levels, but now we're looking at it likely being sometime this year. So the economy is extremely strong. We're going to see 7-8% growth in Q1 of this year. We're going to have very, very strong GDP growth.
Okay. One of the things that you talked about was the high real estate market, and that prices for homes are going up as well as the cost of constructing those homes. So we got a question here that speaks to that. I'll just read it out. Is there a price point where fewer people are going to be able to afford a home? Average jobs may not pay enough to have the kind of purchasing power to purchase either older or newer homes. Is there a point where buyers are going to see a loss of equity gain in the future on their investment or be deterred from buying homes in general?
Yeah, so that's really dependent on interest rates. So this is our big concern and why we have a bit of a slowdown / downturn in 2022, and that is the affordability issues. So, just to put this into some perspective, so you guys know our office is west and north of Boston, so I'm in the area. And so we all know what home prices are like around here. But anecdotally, one of the guys I work with, he was looking to buy a home in town. The asking price was $750,000. He offered $85,000 above that, and he wasn't in the top 10 people bidding on the house. So are we near a point where we should start to see affordability affecting demand? I would have said yes. I mean, to me, me personally, I said, yeah, absolutely. But anecdotally, we're not there yet. And not just anecdotally, according to the data, if we look at actual sales relative to, sales relative to what's being produced, or even just sales, its demand is still very, very strong. So, so I think the answer to that is, as long as your mortgage rates are going down, your home prices can go up, and it's not really going to affect it because no one looks at the actual price they're paying for their home. They look at their monthly mortgage payments. So once interest rates turn, and they're still quite low, but if we see another 50 basis point increase in interest rates, I think combined with another $100,000 increase in, or let's say it average across the country, another 50,000 in the Northeast, if you're looking at a $100,000 increase in average home prices with a 50 basis point increase in interest rates, you're going to see this affect demand. And our forecast assumes that's going to happen by the end of this year. So we're looking for housing starts. We're looking for demand to decrease in Q4, Q1, Q2.
Okay. Moving on to repair and remodeling. I don't know if you follow the Harvard LIRA index, leading indicator of remodeling activity,
Yeah.
but they predict fairly modest increases in remodeling activity after the first quarter of 21. And one of your own slides showed fairly modest increase, or actually declines, if I'm remembering.
Yeah, you are correct.
In modeling. So how do you square that with your talk of robust markets and increase? Is that a capacity thing or what?
Yeah, so just, I mean, if you look at the LIRA and if you look at it historically, it shows very, very little variance. So, a move of, it's basically flat over time. It hardly moves at all. So if you look at our numbers, which are quite a bit more volatile, and by the way, our numbers come from the C30 Census C30 report. The main driver behind LIRA is the Census C30 report. The data is terrible, but it's the only data that's available. So it's the data that we have to use, but that is a main driver behind the LIRA, that C30 report. So how do we square that? They're showing flat to slightly higher. We're showing higher in the first half of this year and then coming off in the second half of this year. The reason why we expect R&R activity to come off is simple fatigue. So we did see, and maybe not fatigue in that people are tired of spending money, but fatigue in that a lot of activity took place in 2020. There's a lot of activity taking place in the beginning part of this year. Product prices are 3x what they were last year. So if you're looking to do a renovation on your house, you're spending a lot more money this year, in the second half of this year, than you would have last year. So that combination of much, much higher product prices and the fact that a lot of people who could have done this work did it in 2020, in the first half of 21, leads us to believe that we're going to have a bit of a slowdown.
Okay.
Again, not till the latter part of this year in 2022, but still, we think it's coming. It's at least good to plan for.
Yeah, but fairly modest slowdown, not
yes,
still above trend.
Yes.
Yeah. Kyle, if you could put up our closing slides, I want to make sure that my contact info is up there for people that want CEU credits for this.
I tried to stop sharing my screen. Hopefully that works.
Okay. Yeah. So yeah, if you want to email me, if you need continuing ed credits, I will make sure you get the information you need. Email me as far as what you're looking for. So any final thoughts, Paul?
No, I just wanted to say thank you guys for taking the time to listen, and I think that this is going to be a very strong year for the industry. It's a solid year for the industry.
Yeah, and I'll just get back to the affordability question again, because we got another inquiry on that. You mentioned the high cost of housing in suburban Boston, and since my family is from there, I can certainly vouch for that. Do you think that those price levels are really sustainable, given that average wages haven't really kept up?
No, I think you're going to see prices come off, but I think so. When interest rates start to move up, I think you'll see the prices start to come off, and we could. You could see prices come off by 10–15%, but longer run, the demand is there to maintain an upward trend. So of course, these markets, they go up and down, but the trend is going to be for higher prices. We happen to be at probably pretty close to a peak right now. Sometime in the next 3 to 6 months, we'll hit a peak in prices. Actually, I think it's probably closer to 3 months in home prices. And then we'll come off, and then we'll bounce off of a bottom that's higher than our previous low was.
Yep. Okay. And then one last question about inflation. I know that, you focus on the lumber markets more than the general economy, but, you did talk about the general economy a little bit. And given that we're seeing this increase in spending power among consumers and supply constraints and it's not just happening in lumber and housing goods, we're seeing it across the economy. Are you worried about inflation spiking or increasing significantly in a couple of years?
No, and an emphatic no. So why is it? Well, let's look at what happened over the past 4 years. We had full employment. I mean, we're talking, 2% or I'm sorry, 3% unemployment rate. So extremely low unemployment. We were running massive deficits, $1 trillion deficits, and we saw almost no inflation. So that indicates to us that there's very, very little inflationary pressure. And if you scratch your head and say, how can that possibly be, which as economists we do, one of the reasons for that is that historically, if you have a closed economy where you increase the amount of money that's getting pumped into that economy, which happens with deficit spending, so there's a bunch more dollars getting pumped into the economy. If you have a closed economy that has to produce all the goods, and you're at full employment, that all that money just leads to higher prices. But we don't actually have to do that. With an open economy that imports goods, we can actually take some of that money that's being pumped into the economy and buy imported goods. And the labor costs in other countries are low enough such that we don't see any inflationary pressures developing. So yeah, so because of that, I think we're highly skeptical of any inflation over the next couple of years.
Okay. And with that, I think we'll close it off. And I thank you very much. I will note to the attendees that the recording of this will be posted at farmcrediteast.com/webinars. Give us a day to get the recording up, but it'll be there by tomorrow. And with that, we will adjourn.
Thank you guys very much. I appreciate it.
Thanks, Paul.